Good morning. My name is Hilary Benn, and I'm chairing this evidence session today of the UK Trade and Business Commission, which is looking at the question, has UK government policy made the cost of living crisis worse? And we have a wonderful panel. First of all, this morning, we've got two panels, and I'd like to welcome Alfie Sterling, David Blanchflower, Francis Coppola, and James Smith. Alfie is Director of Research and Chief Economist at the New Economics Foundation. David Blanchflower is an economist and economics professor at Dartmouth College, New Hampshire. Francis Coppola is an economics commentator, and James Smith is Research Director at the Resolution Foundation. So you're all very welcome. I'm going to kick off with a very simple question to which I'd appreciate succinct answer. Has our new trading relationship, if I can describe it this way, with the European Union made the cost of living crisis worse? Can I turn to you, David, first? You're on mute.
It certainly appears to. We will see how this thing unfolds, because obviously over the last month very much has changed, but I think the answer is it probably has, but others are probably more of an expert on that than I am. But it certainly looks I mean, I sit in the United States, and the situation looks somewhat worse here, although globally I think we're all in recession. I'll talk about that in a minute, but it seems to me that Brexit is a big part of it. And some of the data we've had in the last week, I think, around the world is bad, but the UK does look much worse than everywhere else. But let's hear from others.
Okay, thank you very much. Francis.
I think, technically it must have done, because Brexit is a hit to productivity. It impedes trade between businesses on either side of the channel, obviously, but it also impedes trade between businesses within the UK and just generally adds to the cost of doing business. That is going to drain productivity, and therefore it will make the cost of living crisis worse, simply because if you hit productivity, then you are less able to generate income, real income that raises people's wages and makes them able to ride out inflationary supply side storms like those that we've got at the moment.
Thank you very much indeed. James?
Well, I suppose the immediate effects post-referendum, the big depreciation in sterling had quite a sort of big real terms shift in incomes. That was worth something about £800–900 of incomes immediately. That's the kind of bringing forward of the effect of Brexit. Some of the things that Francis is just talking about, which I would definitely agree with. I suppose the big question is, as lots of global supply chain problems are still there, whether Brexit adds additional frictions into that. And then on that, I agree with Danny that, there's still more to dig into in terms of the effects of that too.
Thank you. And Alfie?
Yeah, I'd agree with our panelists. I think that the productivity hit, as Francis talked about, is important. James is right, that was brought forward for a currency hit. I would just add that I think that though it no doubt has had an adverse impact, it's not the largest factor in the UK cost of living crisis. So global supply chains disruption that are common to lots of countries, and actually domestic policy stance as well, I'd say are two probably more important factors for the particular experience in the UK.
Well, that is a wonderful start in terms of succinctness. That's terrific. I'm now going to turn to Tamara Chinchik, who is going to ask the next question. Tamara, over to you.
Thank you, Chair. Over the past few weeks, we've seen the government essentially forced to U-turn by the markets. Is it possible to estimate the cost of this to the UK economy? How will we see this reflected in the future? And I'd like to start with you, please, Alfie.
Yeah. It's difficult to estimate the cost because, to be honest, we're sort of, I think, some way away from the times when economists could predict the sort of the future, even 6 months out, let alone anything longer. Essentially, the effect of the effect from the mini budget and the premiums that incurred in terms of interest rates and gilt rate have now largely have largely reversed. So there will be the long-term effects then, or the kind of the effects beyond that, become things like, well, are we now more likely to incur those sorts of premiums again because we've bumped up against that edge, we've invoked particular responses? That's one thing. I think that another form of cost is then, of course, to the extent that that affects future output growth, productivity, etc., and the bank then responds with higher interest rates, that will clearly have an impact on living standards through suppressed income earnings and higher unemployment. Having said all that, I would say my biggest fear about the biggest cost is probably more of a policy political one, which is that I really worry about us learning the wrong lessons from the last month's events. In particular, I worry that the lesson that we will learn collectively, I mean sort of the UK debate, the media, politicians, is that we bumped up very quickly against constraints to any sort of government borrowing, and that such borrowing will always incur the sort of response we saw and the costs that come. In essence, I think I'm worried that we learn the lesson that there are big limits to government borrowing to support the economy, whereas actually what we really learned was there are very real limits to borrowing and failing to support the economy with that borrowing. So the type of borrowing is critical. And my biggest worry is that that nuance gets lost and that incurs a cost in the future in terms of the policy we see going forwards.
Thank you. I'd like to go to you, Francis. It's the same question, but I'd also like you to just consider and reflect what this does to the mortgage market as well, slightly in your answer, if that's okay.
Yes, funnily enough, we've just been talking about this morning. I think that one of the surprises, perhaps, in this whole sort of debacle over the last few weeks was just how sensitive the UK economy is to interest rate changes, and that plays out through the mortgage market. And it's because of the UK's unusual mortgage market. I think it's almost unique in the world in being almost entirely variable rate. Or adjustable rate. And that means that there's an immediate transmission from interest rate rises through to households, and also from disruptions in the gilts market through to households, through the fixed rate mortgages, which where the banks are using gilts as funding. And that, I think, wasn't fully appreciated before. I think the Bank of England knew, but perhaps the government didn't. And maybe that is a policy lesson that government needs to learn, is that actually there is a reason why we need to be very cautious about things that affect interest rates in the economy. And maybe a policy lesson is that we need to rethink the structure of the UK housing market and make it less sensitive to interest rates, because although it's a bit of a luxury for the Bank of England having that direct transmission of monetary policy directly through to household, it's a bit of a double-edged sword. And when you get this kind of volatility and this type of policy uncertainty, it can actually mean long-term or maybe even permanent costs to households, and through them to businesses, quite a big demand hit to the economy, which isn't easy to resolve when you've got rising inflation.
Yeah, that's an excellent analysis and something I'm learning a lot from. Thank you so much. Over to you, please, James.
So agree with a lot of what's already been said. Just to put some numbers on it, I agree with Alfie that much of the market moves have basically unwound since the 22nd of September, since before the mini budget. If you look at a slightly longer period, so if you look at how UK cost of borrowing have fared relative to, say, those in Europe since Boris Johnson resigned, there's still quite a chunky premium, something like 0.8 percentage points. That's going to mean that the government basically has to do something like 20 billion more savings and more higher taxes or bigger cuts than they would have had to. So this is, there's a lingering effect here. And while it's true that market interest rates have gone down, we're yet to see mortgage interest rates falling. So there's some signs they're starting to edge down, and maybe they just take time to respond, but they have stayed higher. And the impact, as Francis was saying, of what's happening to mortgage rates is worth something like £3,000 at current rates if you compare back to last December, when mortgages started rising. So it's a huge hit to middle-income households who have mortgages, so that sort of typical mortgage rates. I think I agree with Alfie that the policy implications could be really big here. I think what's happening now is that Jeremy Hunt and Rishi Sunak are in a world where they are, they have a cost of living crisis, the economy that's going into recession, but the key priority has to be not making that worse and not losing credibility. So they're essentially focused on tax rises and spending cuts rather than how do we support people through the tough winter ahead. So we're in a world of second best policy, and the risk is that lingers and we take a sort of even starker message from that going for growth is just ends in crisis. So a lot matters how you do that. So I think really avoiding that big policy fallout will be really important.
Interesting. You're seeing it as a plaster rather than a vision. David, over to you. Of course, it also impacts renters, because if the owner of the property's mortgage goes up, it will impact those who can't afford to get a mortgage. It's one of the most democratic impacts.
Sure. I can bring to bear something on this. I left the UK in 1989 because my mortgage went to 14%, which I remember Alan Winters. I was at the University of Surrey. That actually was my salary. Now, if you look back to the United States, you have 15 and 30-year fixed mortgages. And if you think perhaps in the period 2010 to 2020, when mortgage rates were low, if the UK had passed legislation to allow people to have 30-year fixed mortgages, we might not be in this mess. If you do it now, no one's going to take one out because it's the mortgage rates are so high. Yeah. But I would just add something more to this. I mean, I think that all of this, and I wrote a whole series of columns on it in the summer. I thought all of this was actually eminently predictable where we were going to go. But it seems to me now, though, markets sit on a knife edge. And I think the surprise to me actually was the speed of the collapse. I'd not really expected on the Monday for pension funds to fail and on the Tuesday mortgage markets to stop. I mean, this is having implications to everybody, and it's had global implications. I mean, I know the Fed's been worried about it. I know Janet Yellen was extremely upset with Kwarteng when he came to the meetings at the IMF. And I think it says more things about how we regulate. So if we look this morning, Kocha Lakota has a column in Bloomberg I just read this morning talking about a lot of this is actually about Bank of England regulation and how they've allowed pension funds and others to hold their assets. So I think it brings us to a much greater sort of position, which is we have to think about the whole structure of these mortgage markets. And I agree with what everybody else has said, but I think we're actually sitting at a knife edge. And yes, we've seen bond yields and the exchange rate move pretty well. But I suspect going forward, because of the whole infrastructure and the way this thing's set up, I mean, I would not have thought a month ago that the pension funds were basically going to collapse within 3 hours. So if you then sit there, then you have to say, well, this baby isn't over. Of course, we've seen bond yields fall, but what is the government going to do when we actually try and announce these measures? You should have introduced long fixed mortgage rates some time ago, and now you're stuck. So I think we're sitting at a knife edge. Renters and mortgage holders and all the rest of it are in a mess. But I'm really very worried going forward, especially how if you're ever going to start to think about rate cuts, but spending cuts, we're in a problem. But I think the way to think of this is we're sitting at a knife edge, which we didn't understand. And what's happened in Britain has shown the world that the regime we're in now is extremely fragile. And this is really a bad part of what's happened. I mean, so Francis nodding, but what we've seen is, in fact, the whole infrastructure, it's more than renters. The whole infrastructure is much more fragile than we thought. I mean, I want to hear what others say, but all the things they say are right. But if the infrastructure is really bad going forward, we're in trouble.
Thank you. That's the point of positivity to hand back to the chair. Thank you very much.
Tamara, thank you very much indeed. Now, Anatol Kaletsky is next. Anatol.
Hello, thank you. We've been speaking about the countrywide costs of what's happened in the last few months and 30, 40 billion black holes and so on. But how will all this affect individuals in the economy? And particularly, I think in the last question, we emphasized the mortgage effect, but really it's the inflation and the energy prices that have been mostly responsible for the cost of living crisis. So how do you see the recent events unfolding over the next year or so in terms of inflation, cost of living, the changes to the energy price cap, and so on? I know Resolution has done a lot of work on this, so maybe we should start with James.
Yes, a really big question. So, basically, the key thing here is the UK suffering an absolutely colossal energy price shock. So if you look at the impact in terms of income absorption, it's something like 5 times the size of the shock that we got in the early 1970s that people always talk about as a big sort of energy price shock. So this is really, really huge. We are heading towards the biggest hit to income on record next year. It depends a bit what the government do with policy, how they whether they extend the energy price guarantee, but this is a colossal hit to the UK, and the fact that we're paying more for the things that we consume domestically means that we are poorer as a country. And I think the fundamental dissonance at the heart of or at least one bit of it, at the heart of the Liz Truss policy experiment was not recognizing that the reason we're heading into recession is because we are poorer and we've been hit by higher energy prices. The really big question is, what will the government do going forward? So the big worry is that we slip into particularly working age benefit cuts. And the key thing to keep in mind here is the way benefits uprating works is benefits were only uprated by 3.1% in April, given that was the previous September's inflation number. The current September inflation number is 10.1%. So what we would normally do is catch up next April. If they don't do that, if they raise it in line with earnings, which is a number more like 5, you are heading for a really, really big hit to incomes. And we're already seeing price of food jumping at the highest, the quickest rate since the 1980s. We've seen the ONS tell us that half of households are already saying they're struggling to pay their energy bills. So as I was saying earlier, the kind of second best policy world that we're in, trying not to make the situation worse, that cannot be at the expense of ignoring the impact of cost of living on households.
Yeah, perhaps could I turn to Alfie, because you mentioned earlier your concern about the policy impact, but this is a specific policy impact which seems to me to be the most serious one, is that it now looks, as a result of the U-turn, that they're going to shorten the energy price guarantee to just 6 months instead of 2 years. They're not going to upgrade social security payments and so on. If that's the case, what do you think will be the impact on the economy and the lives of individuals?
Well, the way I think about it, I agree with everything James has said, is that there's a sort of a pinch on living standards that comes from 2 directions. One is the underlying fundamentals that, in terms of energy and food prices primarily, and of course, even if they begin to peak in the coming months, that still needs to pass through the system. And will be felt by consumers still months in advance. It'll take 12 months at least in many cases for it to really move through the system. And I'd add as well, of course, that's just the stuff we know about. So that's absent a further supply shock of some kind. So that's just the pain that's already in the system. That's one part of the pinch. The second part of the pinch is the side effects of the medicine we've already administered to try and address that. So we talked about financial instability and the fragility. I think David's spot on in terms of that. But of course, that also has the sort of side effects you already knew about, which is the mortgage effect we've talked about, but also suppressed earnings and higher unemployment than would otherwise be the case because of the higher interest rates, the higher base rate the bank has administered, partly to address inflation or the prospects of inflation becoming embedded. So that double pinch, if you like, on living standards inflation, energy and food, and then mortgages and lower earnings and higher unemployment than would otherwise be the case. The only other thing I'd add is you did open the sort of the question with a sort of commenting on the £40 billion, I suppose, fiscal black hole, talking about that as the aggregate problem, if you like, and then this being the problem felt by families. I probably wouldn't characterize it like that. I think that there is really only one problem, which is in essence, which is the economic fundamentals and the impact that's having on people's living standards and the wider economy. The fiscal black hole, I think, is a bit of a distraction. It's largely spurious in the sense that it's a function of forecasts and a function of the precise targets government sets itself. It needn't always be spurious. It could be really serious sometimes. But right now, you can already see from things like an improved forecast, pushing back the date of the statement. If government were to push its targets back a couple of years, that wipes out most of this supposed fiscal black hole. So that tells already it's within the margins of things. It's rather than a serious policy problem, in my view. So there's a category difference between the two, not just an aggregate versus distributional.
I'm really glad you made that point. I completely agree that fiscal black hole is just an accounting fiction, really. It's got nothing to do with economic reality. I agree. Francis, do you have anything to add? I'm sure you have on this issue.
Yes, we've spent like over a decade trying to kind of sort of compensate for everything with nominal stimulus, and we're now being hit in the face by real shocks that don't readily resolve themselves with nominal stimulus. So, or nominal, and a nominal contraction just makes them worse. So it's a little bit of a policy dilemma here. And as James said, the reality is, because we have these brutal terms of trade problem going on, we are poorer, and we have to recognize that we are poorer. The question is therefore a distributional one. Who is going to take the hit? At the moment, thinking as a government, using the fiscal black hole as an excuse, appears to be that the poorest should take the hit. I think this is a mistake. Not least because it's strongly recessionary, actually, to make the poorest take the hit. Quite apart from, I mean, it's also humanitarian, from a humanitarian point of view, it's a mistake, but it's also very strongly recessionary. And particularly when you look at the kind of supply side shocks we've got, they're in essential foodstuffs, it's in energy. And those are the things that disproportionately affect the poorest, actually. So the price of pasta goes up by 60% or whatever it is, that's going to hit the poorest in our society because they eat pasta, because it's a cheap foodstuff. And those kind of shocks are not going to go away because foodstuff price rises like that, and energy price rises are stemming from the war in Ukraine, and that's not going to be resolved anytime soon. So the question is a policy question about how we deal with the fact that as a nation we are going to be poorer. We are already poorer. We're going to be poorer, and who should take the hit? In my book, it should not be the poorest. So we should be looking at policy that protects the poorest as far as possible from the real income shock. And maybe it is a matter of letting those towards the upper end of the income distribution take the hit, because if they don't, then we are going to have huge problems controlling the inflation, I think.
Thank you. That's a great point. The distributional effects, as Talleyrand said, it's worse than a crime, it's a mistake. Yeah, that's a very good point. Danny, just briefly, your comments on it, and maybe specifically, what role do you think that the inaction of the Bank of England had in creating this crisis? You know, they only intervened after 4 or 5 days to save the pension funds. If they had coordinated their policy better with the government, do you think maybe part of this crisis could have been avoided?
Yeah, and I agree with that. As I say, Coach Lakota's column this morning basically puts the blame actually on the bank. It's two things, Anatole. It's not just that they didn't react fast enough. It's that the infrastructure and the way that they allowed the pension funds to hold their assets was something they should have realized was not sensible. Mm-hmm. But can I just take it a little differently? I mean, I agree with everything Francis just said. So, and the comments from the others I think are important. But let's just put this in a macro monetary policy, because fiscal policy is relevant and so is monetary policy. And unless we think that more shocks are coming, it seems to me that if you look at the data now, inflation has peaked. So in the United States, in the last 3 months, we've had 0.4 or annualized at around 1.6. We had 2 temporary shocks hitting these economies, and now inflation is slowing. And in actual fact, it seems to me that you're probably faced with a situation now because of macro errors, that actually what you're going to see in a year's time is deflation, not inflation. The 2 shocks are disappearing, unless you think that there's complete pressure coming from labor markets or other things. Well, perhaps there's another shock coming, but essentially you should ignore that. So the macro error we have, Anatol, is obviously part of the way that you've regulated things. But the fact that you're thinking about raising rates is actually made much, much worse. The evidence, in fact, I mean, think of what Francis just said. Yeah, you worry about distribution, you worry about going into recession. The arguments being made today, if you look back, are almost identical to the arguments that were made in the spring and summer of 2008. So why would you be in a position at the Bank of England where you think that you're going to raise rates at the next meeting, which will make everything worse that Francis has talked about? The reality is now central banks have overcooked it. They didn't really understand that we're in recession. And if I was at that meeting or the next meeting, I would be voting for 100 basis point of cuts. That we're starting to see slowing of, people were broadbent talked about, the fact that rates weren't going to rise. But why would you be raising rates when peak inflation has gone? Everything was driven by 2 shocks. So basically the way to think of inflation is 12 single numbers added together. We know 11 of them every month. We drop 1 and we gain 1. And what we're going to see, unless another shock comes, what we're going to see are big numbers dropping out around the world and small numbers being added. So essentially what Anatol is right. The danger is everything that Francis and Alfie and Craig have talked about is compounded by the Bank of England's error and the Fed's error. And I think that's where we're going to go. And I've written various things recently. I think you'll probably, by the end of 2023, because recession coming and because rates are now too high, you're going to be in a world of deflation. And if you take the one piece of data I really like, and I'm happy to send people, the Bank of England actually publishes the longest series of data you've ever seen. They publish inflation back to the year 810. Sorry, 1210. They've got 800 years of data. And what you see with peak inflation is not followed by pretty high inflation. High inflation is not followed by pretty high inflation. What it's followed by is deflation. So if you think of what Francis says, and then you say the Bank of England overcooks it, the fiscal policy goes in and does spending cuts. So I think the Bank of England is hugely to blame. And what you're going to see is we've seen screeching U-turns on the fiscal front. We're going to see screeching handbrake U-turns as the data starts to get horrendous on the monetary front. So I would be voting for rate cuts today. And what you'll see is they'll be reversing things so fast by January that will look like an obvious way to go. And they don't have that much they can cut. And they can't go back to QE for the reasons that we've seen. So the infrastructure has basically made everything Francis said worse because the Bank of England can't cut by 450 basis points, but they've caused a lot of this.
Okay.
Thank you.
Thank you very much indeed. I'm now going to turn to Paul Blomfield. Paul.
Thanks, Hilary. And this is absolutely fascinating, if worrying. But I wondered if I could return to a point that you were making in your opening, which is the kind of relative position of the UK. And I'm conscious that I think Mark Carney said last week that the size of the UK economy in relation to Germany had shrunk from 90% to 70% since 2016, since the referendum. So the war in Ukraine is causing a hit for everybody. Comparatively, can we nail down comparatively how we are faring, and to what extent Brexit is genuinely a factor? So maybe David, you could start.
I'm not sure that statistic is actually right. Jonathan Portis has come after it and said he doesn't think it's right. Alfie may know better than I do. I just think that number looks too big. I think the relative thing is not that large. I just think it's hard to know because there's so much to come, but others are better. Alfie maybe know better than I do, but I think that number's probably wrong. Alfie, I think you'd probably...
I agree. I think there has been a hit. It's not of the order of magnitude that Carney referenced. And in order to get the number Carney used, you have to be very selective on the 2 dates you compare and the indice you use for adjusting for international prices and consumer power. So you can get to that number. It doesn't really reflect what most people would accept as the felt experience out of the two economies, which nonetheless UK has fared worse, but not of that order of magnitude.
So what order of magnitude? I mean, where are we relatively? And not specifically in relation to Germany, but by other comparators. David, I don't know whether you want to continue.
Well, hard to know. I think we're at the top of a cliff edge. Can I just sort of set this up a bit? So in the last 3 days, we've had astonishing new data from, I mean, I like a lot these things called purchasing manager indices. So these purchasing manager indices, which have come out this week, show you the following. They show you that manufacturing and services in the UK, and the UK itself is in recession. So is the United States, and so is the Eurozone. So globally, we're headed downwards. So the question is, what's that trajectory? It's not a great time to sort of compare the trajectory. This is all before. This is basically all in train before the craziness of the last 6 weeks. The UK has just seen big declines in retail sales. We also got negative GDP growth in August. So the context is everybody's going down. To say how far have we gotten remains unclear. It certainly looks that Germany is essentially the one that's going to be hit by the deepest recession. So the question you have to ask yourself is, well, a couple of things. If we compare and everybody's going down, the question is, how deep are they going to go down and how long lasting is it going to be? And what errors are made along the way? And so I think it's a little early to tell, but the global context is you're going to recession. So then if you go back to think about what Francis said, if you're heading into recession, what do? Well, you try and help the poorest people by raising public spending, have cash for clunkers, and you try and help the poorest, and you cut interest rates. So when you put it in that situation, how are we going to do compared to others? The question is, depends upon what macro errors we make, how we respond to this recession. And if you think that the idea that you're going to go and have a £40 billion hole and you're going to impose spending cuts on the poorest people makes absolutely no sense. So the idea of where do we compare, the answer is, well, we're going to look absolutely terrible if we make worse macro errors, although it's true the ECB, they have or are about to raise rates. But I think that what others can chip in, but we're in recession, global economy is in recession, and the question is how are the policymakers going to behave? And it looks to me like it's going to be a disaster because they're going to do the wrong things, just as they did in 2008. The analogy is very comparable. Talking about inflation, where the actual right thing to talk about is output and distribution.
Okay, thanks very much, David. Francis, could I bring you in? Because I thought you made a very powerful and striking point earlier, but I'm still keen to nail down any reflections on our relative position.
Okay, I think there are two things here. One is where we are now in terms of the shocks that are hitting the global economy. And on those, so the Ukraine war, the supply chain disruption, the long-lasting effects of the pandemic, these are what the shocks we're being hit with, and everybody's being hit with them. The countries that are being hit worst, actually, by the Ukraine shock are the countries that are closest to it. You know, gravity models of trade do matter. And so it's not very surprising that Germany's suffering and is going to have probably the biggest recession among major economies, and it's lost its trade surplus and all the rest of it, because that is the nature of where it is. In that sense, we are a little bit protected, but simply because we're further away. That doesn't mean we're not going to be hit, but we are a little bit buffered because of that. So in the short term, I don't think, absent policy errors, as David was saying, that we're going to suffer the kind of recession that some of the countries in the east of Europe are. I think Brexit, though, imposes a long-term drag on the British economy because of what I've already said about productivity, that we don't as yet have any way of counteracting that hit to productivity. And remember, the UK's productivity was already pretty dismal even before Brexit, and Brexit makes it worse. So absent that, I think the UK is on a long-term path of decline, and I know that makes me a declinist. As who was it? Someone in the government dubbed us declinists. But actually, if you look at the history of the UK over the last century, it has been one of gradually relinquishing empire and slipping back down to the status of a small open economy, which is what it naturally is. And I think that's where we're headed. So I would expect to see, over the longer term, structurally higher borrowing costs, structurally weaker currency, and a structurally lower income level generally, unless we can find a way of getting productivity up. At the moment, we're not anywhere on sorting that out, and Brexit is making it worse.
Could I just add quickly to that? I agree with 100% with that. If you think of the issue in the UK following that point, investment has not responded. Investment has been very weak. And you'd have to think of what's happened over the last 3 months. Would you, as a foreign investor, would you think that the UK is a place to go to invest? And the answer has to be that. So if you take everything that Francis has said, the problem, the government's not been able to get investment to come, and you would have thought that that's been hit further. So there's little prospect, but I think Francis is right. But the whole investment story is important. That's why
Okay, thanks very much. James, before we move on, have you got any reflections?
Well, just very quickly, as a matter of fact, the ONS, when they published their new vintage of GDP data, noted that the UK is the only country in the G7 that hasn't regained its pre-pandemic GDP level. So the UK is faring comparatively worse. I mean, basically, if you look across the major economies, there's two groups with the UK in the middle. So the US and Canada basically had very strong recoveries from the pandemic and are close-ish to the pre-pandemic trend for GDP. And the inflation problem actually in the US is quite different. It's one that is related to an economy that is overheating in the face of a sort of structural change in final demand there. So it's a sort of demand-driven inflation to a large extent. Whereas in Europe, the recovery has been much slower. They've been much less aggressive with policy. They've now been hit by the exposure to Ukraine and gas prices and all that kind of thing. We've talked about Germany already. The UK has a mixture of both of those things. So it has an overheating labour market, so it has inflation going up. That's why the Bank of England are raising rates. They're really worried about the second round effects of energy prices in the labour market, even though the economy is slipping into recession. And we are very exposed to European gas prices, and therefore that is having a big impact. So the UK is sort of getting this perfect storm of both sources of inflation.
Okay, thanks very much. I'd love to bring you in further, Alfie, but I'm conscious of time, so I'll pass back to Hilary now.
Paul, thank you very much indeed. Next is Alan Winters. Alan, over to you.
Yeah, thank you, Hilary. So I want to pick up, I think, where Danny has just dumped us and thought, what about investment? I mean, clearly there is a question of Brexit and investment, the last sort of 6 or 7 years in investment. But also I'd be interested to know whether you think, that the sort of chaos of the last 6 or 7 weeks has materially changed the UK's sort of business and investment outlook. So, I mean, why don't I start with you, Danny, since you mentioned it momentarily.
Well, I think that's one of the major parts. I mean, obviously, I sit in the United States. I've been here for, we used to know one another in the 80s, and the world has changed here. And I would say that if you read the commentary here, and if you just look the commentary in the New York Times and the Washington Post and so on, and basically it's become the UK's a basket case. I mean, that's the way that this is written. And then people say, oh, the New York Times, but basically that's how people think here. Obviously, it's part of. In a sense, they write of it as the Brexit delusion. But I think the global view of the UK. I mean, if you think, I'm on Bloomberg all the time, and look at those kind of commentaries. I think that the volatility is such that. This has permanently harmed the UK that was in a position for the years previously that investment has not picked up, much of the reason that James talked about, which is that the UK has not restored its position. So it's hard to think that the communication story has helped. And I sit in the United States. I mean, the president of the United States refused to meet with Truss and said, I oppose trickle-down economics, and I'm opposed to a US-UK trade war, and that's in the narrative. So when that sits in the narrative, you're in a little bit of a trouble. And I think that's, if that's true in the United States, I think you're in trouble. You got to change that narrative for whatever reason, but I think that's done permanent damage.
Thank you. Francis, do you want to add?
Yeah, again, I would kind of separate out the turbulence of the last 6 weeks and set that in the context of how the UK has been trending over some time now. So the gilt spikes and the currency weakness of the last 6 weeks have broadly unwound. We're more or less back to where we were, but there's still this level of, they've just done a screeching handbrake turn, and they're going to do that again, which will weigh on investment decisions clearly by businesses. I would be worried about that myself if I was in their position. But I think also we should place that in the context of actually policy uncertainty now, going back 6 years, really, to Brexit and to all the shenanigans after Brexit and the uncertainty around the relationship with the EU and the ongoing uncertainty around the Northern Ireland Agreement and the general view that it's not actually a very stable or safe place to do business right now. There's all manner of obstacles and all manner of uncertainty, and that's bound to be having a chilling effect on investment. And I can't see that improving anytime soon unless the government has a rethink about the message it needs to be sending to the business community about this is, as Margaret Thatcher put it, Britain is open for business. Right now it isn't. It's got signs up saying building works in process. It's not put on your hard hat. It's not a good place to be doing business right now, and I don't see that changing. So that kind of plays into my productivity story as well, because I'm not seeing any great signs of any improvement in investment, and I'm also seeing signs that the government is going to cut public investment as well. I don't see any good prospects for an improvement in productivity that will raise real wages anytime soon.
Well, thank you. James, have you got anything to add?
Well, it just depends a bit what you're talking about by investment, I suppose. So if you look at foreign direct investment, so this is investment in firms across borders, it's actually held up surprisingly well since Brexit. I think there was a number of predictions that FDI would fall off a cliff after Brexit, and I think there's definitely a puzzle about that. I mean, the data are pretty uncertain. There's clearly a lot of activity in terms of firms in both directions having to set up operations in the UK and the EU to keep continuing with their trading arrangements. But the UK has been an incredibly strong recipient, let's say, of foreign direct investment flows, being one of the highest in the G20 for a really long period, have performed really well relative to Europe, and that has slowed somewhat since Brexit, but it's not like FDI has completely fallen off a cliff. So that has continued. If you're talking about business investment and the sort of general environment for that, then I would completely agree with what Francis was saying. That's been historically weak since the financial crisis, been hit by Brexit very clearly. It's been hit by higher uncertainty. So there are really big headwinds there, and that's definitely part of our weak growth and productivity problem.
Yeah. Okay. Thanks. So, Alfie, any more oil on the fire?
Just to try and say something a bit different, I wanted this relates to the point I wanted to raise under the comparative experience of different countries as well, because I think that, which links back to investment, because I think if your starting point is, the last couple of years, cost of living crisis, Ukraine in particular, the UK is, for the real reason Francis gave, is perhaps not going to have the biggest shock. But if you go back 12 years, the UK actually does have quite a unique experience, and that is perhaps best exemplified by, if you look at countries across advanced economies, and you put them in sort of quadrants of whether their real earnings have gone up or their GDP have gone up or vice versa, the UK is very unusual in having had GDP growth, albeit very modest, but having had real wages fail to recover 2008 levels. It's near unique, I believe. Don't have to double check the data again, but it's certainly near unique amongst advanced economies over a sort of 12-year period. Now, what's the reason for that? It's the Francis point about our long-term decline in terms of the productivity hit, which part of which is business investment and public sector investment. It's also austerity outside of that after 2012. It's also Brexit. But the reason we've already felt it, because that's a long-term impact, is because the currency has dropped off several times in the last 12 years in anticipation of that long-term decline. And it's dropped off faster such that consumer prices have outpaced the anemic growth. So we've brought forward that pain into the future. And over 12 years, I think that's quite a unique experience for the UK of slow GDP growth, but no real growth in real earnings.
Okay, thank you. So, I mean, it does sound a bit pessimistic in the sense that, one hopes that investment will pick up, but, in a sense, the problem you identify is that actually the wage share has gone down.
Okay.
Anyway, thank you very much,
Alan. Thank you very much indeed. And next, I'm turning to Caroline Lucas. Caroline.
Thanks very much, Hilary. And I guess I'll just pick up where Alan, with characteristic understatement, said it was a bit pessimistic. I think that's certainly how I'm feeling. But I wanted to ask you about better alternatives, what we should be doing. I think we've touched quite a bit already, maybe on whether or not the government's growth plan, whether it would make a difference to the UK's prospects. I don't know if anyone wants to say any more about that, but in particular, are there better alternatives to kind of begin digging us out of the hole that we're in? Should we be talking about wealth taxes? Is there a way of doing QE that wouldn't cause all of the problems that that we know have been caused? And maybe I'll come to Francis first.
I had a feeling you were going to do that. In theory, yes, all of these things can be done. It kind of stumbles on the political will. When you have a right-wing government to empower, your chances of getting wealth taxes through are not great. And the kind of wealth taxes we arguably need are on property, and getting those past the UK population is not easy. But I think that the underlying problem, in a way, is not one of taxation. The underlying problem is one of productivity, as I've said. I think in that respect, there was kind of the ghost of some sense in Liz Truss's ideas, because she did highlight growth and was talking about structural reforms. The only problem was that what she thought were appropriate structural reforms to kickstart growth were cutting taxes for the rich and waiting for everything to trickle down. And we know because there's ample empirical evidence over a long time now that doesn't work, except in the very peculiar circumstances of Reagan's tax cuts in the early 1980s, which, it's worth remembering, were offset by extremely high interest rates of a kind that we now in this economy could not tolerate. So it's not an option open to us. Anyway, we're not the United States and we don't have the dollar. And that's a big factor as well. So I think myself that we actually, sort of picking up the investment point, something I've been saying for a long time now, is that when the private sector won't invest, the government must. And that's been an abject failure of governments over the last 12 years, is that they have not picked up that market-making, pump-priming public investment role, investing in infrastructure, in skills, in generally re-equipping the productive resources of this country to make them even more productive. And in terms of our long-term, how to turn this ship around, if you like, that is, I think, where we need to be focusing. So I would like to see actually more public investment. And I think, despite all the turbulence that the markets actually would wear, a coherent proposal for investment in public services that was designed to improve productivity. So actually, interestingly, investment in transport networks is one area where I think there would be a market appetite for that. And also things that people don't think about as public investment, but actually kind of, if they're not addressed, create rigidities in the labour market that actually make productivity difficult. So it's something I've been going on about a lot recently, is actually social care, because of the silent drain of older women, skilled and experienced women from the workforce. There's a form of hysteresis in the labour market, and we really don't need that. The more public one is affordable childcare, which also takes women out, predominantly women, out of the workforce. And also, people who are stuck on NHS waiting lists and unable to work. It's another drain on, it reduces participation rate. And if they are working, then again, there's a form of hysteresis, because people who aren't stuck on waiting lists waiting for treatment are ill. So there's things like that we don't think of as investment, but I think we need to start talking about them differently in terms of actually creating a more productive workforce and improving our productivity that way.
Thank you very much. Can I come to Alfie, not least because, Alfie, you were saying earlier about the dangers of government learning the wrong lesson when it comes to borrowing to invest. Could you say a little bit more about that and what other alternatives you might see?
Yeah, so I think there are two problems that we've discussed. There's the short-term or medium-term sort of supply-side inflation shock and cost of living crisis, and there's the long-term structural. We've been discussing both of those. I think on each of those, government could take a very deliberate and effective course. I think on the first, my line of reasoning would be we have supply-side driven inflation. There's not a huge amount of evidence that is in a really serious way embedding in domestic inflation pressure and domestic wage pressure. Therefore, I agree with Danny, there's not really a strong case for rate hikes, all the rest of it, winding down quantitative easing. Therefore, your response should be use fiscal policy to address the distributional consequences of inflation as it passes through the system. And if you need to, raise taxes to make sure you have the fiscal space to do that. So halt rate rises, perhaps even cut them depending on, as Danny was saying, but certainly move to fiscal, distributional and tax rises on the fiscal space. So I think that's I would say the correct response to the current medium-term problem. On the structural, I agree with Francis and all the points he's making around the type of investment. I think the thing that I would add is that I wouldn't, I don't think any element of actually what Truss was trying to do is right. And insofar as, and this may well be heretic, but I don't think that just going for growth is particularly helpful, because in the end you have to ask yourself the question, what is it you want from that growth? What is the thing you're hoping to get? And I would say in almost all instances, target policy at that thing. If it's higher incomes, talk about higher incomes and how do you deliver that? If it's more affordable, better quality services, better quality goods in the economy at lower prices, focus your policy on that. If it's lower carbon emissions, focus your policy on that. If it's high NHS waiting lists, both for health and well-being reasons, but also the effect on the labour market, people not being able to work, focus policy on that. And I think you'll find that growth is a byproduct of that, but I don't think we should be too worried either way about that byproduct. We should focus on those outcomes. And if you start there, that will lead you, I think, fairly quickly, if your political mandate to do that, to the types of policies we need, and many of the things that Francis was talking about.
Lovely, thank you. Danny?
Yeah, it made me think about what you might do in terms of the labour market. I'm a labour economist. Let's think to what these folks have been saying. So the reality is that actually real wages in the UK have remained pretty low, but let's set this in context. Over the last decade, firms have had the ability to pay workers more, right? They chose not to. They chose to pay it to shareholders and they chose to pay it to their CEOs. But they could have paid it to workers, but they didn't. Now, the governor of the Bank of England comes in and says, aha, workers have got to be constrained in what's going forward. Didn't actually say that firms could, in fact, could take the hit. They could take a hit to profits. They could take a hit to CEO pay. So in some sense, you might think that productivity is, labor's a big part of this productivity story. And basically, pay of these workers has been relatively low, and they could have been higher, and they chose not to make it higher. And so the idea of a wage price spiral doesn't really make any sense, because you have the ability to pay the workers more and you didn't. So I think what you've done is lack of motivation of workers. But let's just take another one. So I've spent a lot of time recently trying to think about what impacts people's effort, if you like, what impacts their productivity, why they would bother. But let's just go to something I think which is pretty interesting, which is underemployment. So let's, if you've got a job, in the past, what you saw, was that wages were impacted by what was going on outside by people you didn't know. Well, now what you've seen is firms have set people inside organizations on each other, because there's insiders and there's outsiders. And what we see now is wages are hugely impacted by lack of hours. So think in an organization, there's me and you, we all get enough hours that we like, but there's this group of people over here who don't get enough hours. They're underemployed. This has been a huge phenomenon in the UK economy. So now wages are impacted by insider pressure. The wages of people within the organization are impacted by people who they know within the organization. So you've set people within organizations on each other. So if you pay peanuts, you get monkeys, you know, basically. So what I think you see here, a big part of Francis's story is that you haven't paid people enough. You've decided on the private sector to pay as profits and CEO salaries. You haven't given incentives for firms to pay people more. So why would they care about productivity? They can't get enough hours. And then let's go to the public sector. So in the public sector, what you do is you underpay people in the public sector and then you expect them to perform. Well, what happens is they quit. The quality of the output declines, if you like. The quality of the service comes because, you know, people are just quitting. They're not slaves. So I think central to Francis's point is that workers' pay has been kept down voluntarily. CEOs have taken it to themselves, and it's not surprising workers can't get enough hours, and basically you've reduced motivation in the workplace. What benefit is there for a worker to improve the productivity of the firm, to raise the profits of the firm when they don't share in the gains? So I think that's a big part of the story. And so Richard and Murphy and I wrote a thing in the Mirror this week saying, you know, the big deal in the public sector is actually give them inflation adjusted pay raises. What you've done is you've basically, by keeping public sector down, you've lowered public sector productivity because workers are scared, they want to keep their jobs, but there is no incentive. There's no incentive for workers now to be productive because they're not going to gain in the spoils. And we know that relative things matter. So what you've done is you've basically created a workforce that you've essentially suppressed and kept down. And the idea that a wage price spiral will come, well, workers think it's about time I caught up. So I think that's a big part of the story.
I'm going to have to stop you. I'm so sorry. Time is running away. James, is there something massive that you need to add on that question? Otherwise, I'll come to you first with my next one.
Well, just to say that the Resolution Foundation is working on a 3-year project about how to get growth, the Economy 2030 inquiry. It's a massive question. For me, the big thing here is that you need a clear strategy for getting growth, and your macro policy, your education policy, your industrial strategy, all of that need to be joined up in order to drive growth. I think the thing people often miss here, and one of the things that makes Brexit so significant, is that the strategy that the UK had was one of driving manufacturing productivity improvements through international competition, plus access to a very large services market that really doubled down on our specialization in services. And without that close relationship with the EU, it leaves a gap in terms of what that big picture growth strategy looks like. And that's the conversation we need to be having, not about what tax rates are.
And when does that get published?
So we're finishing that. We've just done the interim report over the summer this year, and then we're publishing the final report in the autumn of next year.
Okay. I think I'm rolling on to the next question. That's right, isn't it, Hilary? So I'll just be very brief doing that. Obviously, lots of known unknowns and unknown unknowns until we get to the 17th of November. But I just want you to cast your minds back to the August leadership election when Sunak promised to cut the basic rate of income tax to 16p by the end of the next Parliament, to scrap regulations on financial services, and to continue with the rise in national insurance that was scrapped in Liz Truss's mini budget. I just wanted to ask how practicable you think those policies are and what impact they would have if they were implemented. And if there's a way that you could sort of answer in 3 sentences, that would be marvellous. I'll come back to James first.
Well, I think it's very simple. The government has to prioritise spending cuts and or tax rises now to regain credibility. So the idea that we're doing big income tax cuts, I think, is for the birds at the moment. I'd be very surprised to hear Rishi Sunak even sort of promising in that direction. I mean, this is clearly a debate about the level of taxes for the Tory party. I think the evidence that this would drive faster growth is pretty weak, as others have talked about. And the big issues around the distribution of income are better handled in other ways potentially, but very surprised if we see that. Okay,
thank you. Alfie, 3 sentences.
2 sentences. It's not practical. We have a long-term pressure to raise taxes, not cut them. If you're going to be raising taxes, national insurance is one of the worst ones, because it makes worse a current imbalance we already have between taxation of earnings versus taxation of income from wealth.
Thank you. That really was brief. Danny.
The last thing in the world you need to do in a recession is to cut public spending.
Perfect. Thank you. Frances.
I don't think I could be more succinct than that, really. I think that the kind of tax cuts that Sunak wanted to do are now impractical and actually counterproductive, because they would be inflationary. What he should be looking at more is distribution, as Alfie and James was saying, and then over the longer term, investment to drive growth.
Lovely. Thank you all so much. And sorry to cut you short. I know we could be here all morning, but I'd be in big trouble with Hilary, so I will pass back.
Never. But thank you very much, Caroline. Right, we come to the final question for this first panel today, and I'm going to call on Jeff Mackey to ask it. Jeff.
Hilary, thanks very much. As a closing riposte to what's been a fascinating session, we're going to have a general election in the next couple of years. That's the way it is. I wonder, for those of us who are trying to look at investment and innovation, would you like in a sentence to give me some clue what sort of economic situation you think the next government's going to inherit? There's a good one, just to finish. Try being as brief as you can, please. Could we start with Danny?
Well, it's really hard to know. I think you can use the United States right now. All the issues going on in the US, it certainly looks that the economic situation is essentially going to cause the Democrats to lose the House and the Senate. So it's hard to think that we're going to see good times over the next 2 years, and whenever there's an election, the party in power is going to get impacted.
Thanks, Alfie.
I mean, as I mentioned previously, I think if you want a forecast to predict the future, which actually often isn't what a forecast is supposed to do, then it's not going to be very helpful in 2 years' time. There are too many uncertainties, too many unknown unknowns. That said, if you wanted to have a sort of core scenario, which is based on the information we have now, what do we currently expect? And you'd use that to sort of compare changes as more information comes in. I think that's effectively one of a shallow recession followed by, or stagflation, with growing inequality as part of the byproducts, and this policy can do more, followed by probably a very uneven and very modest recovery over a sort of 2-year horizon. That's sort of best case scenario as things currently stand. And you just effectively inherit an economy that's broadly stagnant, rising inequality in 2 years' time.
James.
I think the reality is that the next governments are going to inherit a set of public finances that still need a lot of repair, and are going to be facing still the big structural problems that we have in terms of low growth and low standard of living since the financial crisis. So it's going to be a real tough job for the next government, essentially.
And Frances, please.
Broadly what James said, really. I think that it's easy to get distracted by current kind of turbulence and ignore the long-term structural trend in the economy, which has actually been shrinkage really for quite a long time now. And I don't see any evidence that that's going to change. So the next government is going to inherit a smaller economy with widening inequality and generally poorer, lower real incomes are quite a long way up the wage distribution.
Thank you. Chair.
Jeff, thank you very much indeed. Look, on behalf of the Commission, can I say to our 4 witnesses, Alfie, David, Frances and James, that has been a wonderful, if depressing, session, because you really have given us the benefit of your knowledge and expertise, and it makes us realise even more than we probably knew already the challenges that we are facing and the importance of people who've got the power and responsibility of making the right choices rather than the wrong ones. So thank you for giving up your time. We really, really appreciate it. And you're welcome to stay if you want to watch, but I'm sure you'll have other things to do. We now move, I hope, seamlessly on to our second panel today. And it gives me great pleasure to welcome Helen Dickinson, from the CEO of the British Retail Consortium, Josh Green, Head of Public Affairs at the Beer and Pub Association, and Craig Beaumont, Chief of External Affairs at the Federation of Small Businesses. You're all very welcome. Thank you so much for giving up your valuable time today as we continue to explore the question of, has UK government policy made the cost of living crisis worse? And for the first question, I'm going to turn to Alan Winters. Alan.
Thank you very much, Hilary, and welcome to the new members of the panel. I'd like to ask, I guess, each of you to sort of talk about your membership in general, and say, and ask sort of, how are you experiencing current economic conditions and the extent to which the chaos of the last 6 or 7 weeks has changed that? So in a sense, a slightly longer term view, and then anything immediately from very recent history. So why don't we start with Helen?
Thank you. Pleasure to be here. That's a hard question to start with, Alan. So I think many retailers talk about the current conditions as almost more challenging than COVID, because the issues are on multiple fronts as opposed to just one big issue. So we have on the demand side, consumers are obviously pulling back their spending. So the sort of levels of retail sales have been slowing over the course of this year. In some categories they are still up, but volumes are falling because there is inflation in those numbers. So that is having an impact on retail businesses on the demand side. On the cost side, so all the input costs, they've got cost pressures coming from lots of different directions. Global commodity prices have gone up. I'm sure you've been talking about staff shortages in the previous session. So that is pushing wages up for employees, which is good, but it is also meaning that costs are going up for businesses, transport costs, shipping, increased taxes on things like business rates, which I'll come back to, I'm sure, during the course of this. And so what we're seeing is a lot of profit warnings across the industry, and we are also seeing some of those costs being pushed through into consumer prices. So, us all as members of the public are paying more for the goods that we are buying. And in terms of, I guess that is a little bit of a perfect storm in terms of backdrop. So a lot of businesses are running very fast, almost to stand still. Obviously, with the energy price increases over the course of the year, then that added another layer on top of it. So coming back to in the last 6 weeks, the intervention on energy support for the immediacy of the 6 months was helpful, particularly for smaller businesses. Larger businesses generally tended to have hedged their energy beyond that 6-month period. So for the industry as a whole, the biggest question is what happens after the 6 months. But there's no doubt that relief has been valuable. But more widely, there's sort of the general turmoil in the political discourse is not good for consumer confidence, and anything that is not good for consumer confidence is not good for retail, because it has an impact on demand as we look forward. And it's a bit of an old cliche, but they call it the golden quarter because it is the golden quarter. Many retailers make their money in the next 3 months because this is it's Christmas, in case any of us have forgotten. And therefore, what happens, right now and in the next sort of 6 to 8 weeks is really vital for many businesses. So building back that confidence, enabling consumers to feel a level of certainty about the future is the most important thing. for the industry as a whole, along with what happens on some of those cost pressures, most of which are outside the government's control, but some of them do sit within it.
Yeah, thank you. So, Josh, how about your sector?
Yeah, thank you. Thank you very much. And just to say thank you very much for inviting us to take part in the session. The work of the Commission is very important, and we're very grateful to have the opportunity to address you all today. I think just to, I mean, as you'll expect, the conditions across the three contributors today are likely to be the same. So I don't want to repeat anything Helen's already said, but conditions are frankly very, very tough out there. And I think if we look back to the start of 2022, there was a kind of, believe it or not, there was some optimism in spite of inflation already beginning to creep up. Even at that point, we at least had the prospect of restrictions on pubs being lifted, and hope that we could all start to repair some of the damage done by the pandemic. And I mean, it's important to note that we were, as a sector, very grateful for the support we had in that period, but it's, it should be under no illusions that there was a lot of damage to repair, and the extent to which it subsequently felt like out of the frying pan into the fire, it really can't be underestimated. We hardly had a chance to draw breath before the impacts of the cost of living and cost of energy, just general cost of doing business crisis began to be felt. And it really, over the last, I suppose, 3 or 4 years, does feel like it's one crisis after another, and each one is more serious than the last. And that's a key piece of feedback we've had from our membership is, believe it or not, this is worse than COVID. And I guess some of that is a cumulative effect, obviously, and you would kind of expect that, but I wouldn't want anybody to think that this is anything other than an acutely difficult time to be doing business. And just to touch on some of those comments that Helen made, there is that lingering uncertainty that we don't know what's going to happen after this initial 6-month support package, thinking specifically about the energy help. And we are hopeful, of course, as I'm sure Craig and Helen are, that there will be some support beyond that. And certainly from our sector's perspective, pubs having been specifically called out by the now former Prime Minister in her speech in September as a quote unquote vulnerable business sector, we are hopeful that it will continue, and we're feeding into the review of the policy as we speak. But there isn't that certainty there at the moment on what that will look like, and the level of stress in the sector for both brewers and pubs, for retailers and producers, is certainly elevated and has been for some time. And it's that kind of the uncertainty really just adds to that level of stress. And we would just urge the government in strongest possible terms to clarify the support beyond that 6-month period as soon as they can.
Okay, thank you very much. So Craig, how about your members?
I think it's important to put the context before we start. So we lost 400,000 small businesses in the first year of COVID, and then we lost 100,000 in the second year, and that is a net figure. So that's not, there were more people that joined, that's net. So our small business population has shrunk from 5.9 million in this country to 5.4 million. I think that's a really important point just to make, because we've lost small businesses as we come into this crisis. So we're already starting off in a pretty poor place. We've just released research this week on small business confidence right now, small business index, and that fell to 35.9, minus 35.9 for last quarter. That is the worst reading we've had outside of lockdowns. So in our history, we've only had 2 lower scores, and both of those were in reaction to lockdowns, which we know disproportionately hit small business. So just picking up on a couple of points from both Josh and Helen, I think there is a cost of doing business crisis. We're now allowed to use the crisis word. The Prime Minister's using it too. And that underpins the cost of living crisis. And I think we would split it out as 4 kind of big cash flow pressures. The first being that revenues are down. So we've got 43% of our members say that their revenues are down, connected to consumers tightening their belts, as well as businesses too. We see costs rising, so that is driven by energy, fuel, general cost of things that people buy, labour, and taxes. I think we do need to come back to taxes at some point. I was very interested in one of your commentators earlier saying that tax isn't a problem. Tax can be a problem. And 89% of small businesses say their costs are up. And actually 38% say those costs are up by more than inflation. So inflation is at 10.1%. So to see your costs rise more than everything they see outside is really, really bad. The third pressure is pay. Helen referenced this. On average, we're seeing pay increases across small businesses of about 4.5%, and they are working so hard to get to that figure, and yet obviously cost of living outside doesn't match that figure. And then finally, late payments. Whenever there's a bit of an economic slowdown, you see an increase, and we are seeing a huge increase. We've got 57% of small businesses are affected by being paid late, and for a quarter of people, it's got worse since the previous quarter. So those are kind of like the four pressures. And if you like, one of the solutions to that is obviously going to apply for finance. But we've seen a lot of the finance applications shift from being about, positive things like investment and growth, and I want to expand and I want to grow the team, get a second premises. None of that. It's all about cash flow. How do I get through to the next month? How do I get through what will be a very difficult winter to the end? So I think that's the situation for our sector. I suppose I would add on one last thing, which is the kind of things that we desperately need. One of them is the small business energy package, which got royal assent, I think, on Monday, and bills are about to land. Helen's right, small businesses are desperate to see those bills. At the moment, as for a small business, its two biggest bills are normally business rates and rents. And now there's this third thing coming right on the alongside, which is the energy bill. But they don't really know how that will be, what amount that will be. They can't work it out from a wholesale price fix. So I think along with the 6-month cliff edge, which is a very, very big deal, I think you've also got a bit of clarity needed as to when bills will land in the next couple of weeks. Are bills going to be as low as people think? Is enough of the increase going to be removed from those bills? Alongside energy, you've got national insurance. FSB was created in response to an unfair NICs rise, so we were very pleased and pushed very hard, actually, alongside the energy package, for national insurance to be reduced. It's a very bad tax to increase. And 3 elements of the 4 of national insurance have now been removed. That also got royal assent, I think, on Tuesday. So it's all happening all at once. Both these 2 things will mean it will mean help for small businesses in November. And I think that was probably the biggest single thing we needed. So there is some help coming, and I think small businesses need to know that.
Okay, thank you very much. Let me hand back to Hilary.
Thank you very much indeed, Alan. Next, it's Tamara Chinchik is going to ask the next question. Tamara.
Thank you. What are the biggest pressure points facing your sector between now and the end of the year as we approach Christmas? Do you think the UK government's economic plans will ease any of these? Josh, I'd like to start with you. I'm assuming that Christmas is your big time for business.
Yeah, it is. And Helen touched on this in answer to the first question. October and November are historically very tough times for pubs anyway, as the summer trade dies off and before the Christmas trade picks up. And I think what we've got this year, we've got the World Cup complicates matters slightly, because we aren't really at this stage able to get a handle on whether that will be a net boost to trade or whether it will eliminate some of the traditional Christmas trade in favour of football fans. And we know that some pubs are foregoing Christmas bookings in favour of setting aside areas of the pub for football. There's also
is a football customer likely to drink rather than eat, so there's less
generally speaking. And you're also seeing at the moment, because of the general cost of living pressures, people are tending to come in and watch the football in the pub and just kind of nurse a pint or two, and they don't generally tend to spend as much as someone coming in for food. That I would say that does change slightly during a big tournament, because there does tend to be a bit more kind of an atmosphere rather than just club games. So we might see a bit less of that impact. And there's also, unfortunately, there's no guarantee that England will progress in the tournament. I'm not here to comment on the merits or otherwise of the Southgate regime, but if they were to be eliminated early, along with Wales, there would certainly, it would be a massive impact, net negative impact. So you might see a bit of the Christmas trade coming in to fill that gap, but I think it would be really bad for us if they were to be knocked out. And like Helen said, we're coming up to the time when small businesses, particularly pubs, bank a lot of their annual profits. The government interventions so far undoubtedly ease some of those pressures. We're still looking at 2.5 times energy, the cost of energy bills, which is very, very difficult to swallow. And those wider cost pressures that Craig mentioned still persist. Raw materials, things like edible oils, particularly for brewers and pubs, carbon dioxide is a increasingly scarce commodity, and the market for it is going absolutely crazy. And of course, there's staffing costs, the ability to obtain staff, and so on. And on the other side, you've got the pressures from people tightening their belts. Perhaps they're anticipating higher mortgage costs, high holiday costs, and so on. So they will be, we're anticipating, and they already are, foregoing the occasional luxury, and that, unfortunately, that hits discretionary spend like that on hospitality very hard. So the support from government eases some of those problems on the one hand, but it doesn't really touch the sides on some others. And I just also, the other thing, just to briefly note, that the recent decision, and this touches on something Craig mentioned about taxes, I'm sure we'll come on to this later, but the decision not to go ahead with the freeze in alcohol duties from February is going to massively increase pressure on not just our brewing members. It is a producer tax, yes, but it directly impacts on the price producers charge the retailers, obviously. And if we were to see an inflationary increase in February, it would wipe out all of the benefits from previous freezes and cuts, such as the situation with inflation. And for that matter, the benefit from draft beer duty cut that was proposed in the government's alcohol duty review. It would undo all of that. And it would take beer duty to its highest ever historical level, which will inevitably has to feed through into prices in pubs at the worst possible time. So if we would absolutely, or we are absolutely urging a reconsidering of that reversal of that reversal, if you like, and put the freeze back in place.
You're not alone looking for reversals of reversals. Hi, Helen. That brings me to you. Nice to see you again. And I say that because of in our sector, the U-turn on the VAT retail export scheme, the VAT res, is very unpopular. Helen, if you could come in on the question, but also just to expand on the VAT res, because I'm not sure everyone will know about it as well as we do.
Yes, I mean, this is the scheme that you're mentioning there about the ability for tourists to be able to reclaim VAT on their purchases, and it is a scheme that was withdrawn whenever it was, I think, pre-COVID, when there were no tourists, and then COVID hit, there were no tourists, so it didn't really matter. Whereas as it stands today, there was big cheers all round when it was reinstated 2-3 weeks ago, and then subsequently withdrawn by the latest Chancellor. So I think that in the lead up to Christmas is an example of where we're not sort of taking a holistic view on putting our best foot forward and making sure that we are in fact a competitive place for international tourists to come and shop. In whatever part of the country that may be. That isn't particularly solely centred on London. There's a lot of benefit of that flows around different parts of the country. So that is an example of where, looking holistically at a tax issue, and particularly how it impacts the wider economy, is really important. I think I think that fits into, I mean, my sort of broader answer to the next 3 months is the most important thing is rebuilding consumer confidence. So that's the overarching message. I did a very brief data. Nielsen recent survey, 76% of consumers are saying they expect to moderately or severely be impacted by the cost of living crisis over the next 3 months, and that's up from around 50% in the summer. So a gigantic increase. So that would be the most important thing for right now. But I think the second sort of medium-term thing that is also relevant to the next 3 months is bringing some certainty around what happens with the energy package after the 6 months, because not knowing that will impact people's investments
completely
today, tomorrow. And the other one, which has also been touched on, is what happens to business rates in March 2023. Because as it stands today, we are looking at an inflationary increase to the pot of business rates money because of the way that the system works, a default of a 10% rise in everybody's bills. So that's 800 million for retailers and 3 billion for everybody else. And that will just exacerbate the sort of input cost crisis that everybody else has mentioned. So number one, rebuild confidence. Number two, bring certainty to some of these unknowns that will impact Q1 next year, because that will impact the decisions that are being taken today in retail businesses and I'm sure more widely.
Thank you, Helen. Obviously, if someone gets their tax off, they're more likely to spend in the pubs and restaurants and not in hospitality. And we've seen the growth in Paris being the destination of choice above Heathrow for international aviation. So it has a wider impact, and I would urge the government to look at the U-turn on the U-turn on the U-turn on the VAT res. Craig, over to you on the question that if you need me to remind you, I'm happy to do that, because I realise we've gone off onto the VAT res.
No, that's fine. You also the big.
Sorry, can I just say we're slightly pressed for time.
We're behind, I know.
Yeah. Okay. Craig, over to you.
So you asked what the biggest pressure points facing the sector and will government's plans help? So it was going to be a difficult winter. And I think cash flow is one way to look at it and staff is the other. The weakness in the domestic economy, weakness in consumer demand and access to skilled staff are the top 3 barriers to growth pointed out by small businesses in our survey. So, there is a dullness dividend that will now come. Restoring economic stability, rebuilding trust in public finances, absolutely necessary. It's almost like a control factor. It has to happen. If you have that, you have energy support and NIC support coming through next month, then that is actually quite good. I am concerned, though, that there is this dullness dividend could be no reform or changes that we need. And I think tax-free shopping for VAT is one of those. Reforming IR35 was another that was promised and then ditched. The corporation tax rise does catch small businesses because the threshold for that rise is only at 50,000. Now, 50,000 for salaries is pretty good, but that does catch small businesses when they're successful. They'll go above that, and then things like the investment zones look as if they're being ditched too. So all those things are actually quite good ideas. Not everything that was put forward is a bad idea. And I think tax-free shopping actually shows you a problem with VAT, a bigger problem. So as well as hitting tourism and travel, VAT is really hard to administer. There's a chilling threshold of about 85k. So we see small businesses getting close to the threshold, that turnover, and then stopping. So productivity falls. Guest houses are only open for a shorter and shorter period each year. I mean, inflation at 10%, more people are moving towards that threshold and stopping earlier. I think, so just on skills, I think 80% of our firms say they've tried to recruit over the past year and have struggled. So I think this means looking at bringing groups back into the labour market. We've lost 500,000 people from it who are economically inactive. The trend is for it to be men. The trend is for it to be over 50. So this is people leaving the labour market. So you either have to focus something on those or focus on other groups, like we've got a huge disability employment gap. We need to bring people back in, and what do we need to do that? And then without opening the Brexit debate again, we do need sensible reforms to immigration policy to make it easier that, we're supposed to have these youth mobility schemes that should be agreed with the EU. and we can't have kind of skilled worker visas kind of pricing out people. So I think you've probably got a balance of skills and cash flow. One thing I did think from Helen, from your remarks, was about this golden period, and I did have a look, and 52% of our members in retail say they expect the next quarter to be worse, which is stunning for what you say is absolutely the golden period. And I think things like the postal strikes really won't help. And that drives people in our sector away from working with, going and buying a small business online and then getting it delivered. They will switch towards bigger retailers that have private distribution rather than use the raw mail.
Thank you. Just before I hand back, the Migration Advisory Committee are reopening the shortage occupation list consultation. So that is an opportunity to request, put in a really strong submission around skills and bringing people over. Back to you, Chair. Sorry if we ran over.
Thanks, Tamara. Stephen Kinsella. Stephen.
Yeah, thanks, and good to meet you all. Obviously, we've heard from you today about the challenges, and in fact, more than challenges, that for many of your members, that the threat is pretty existential. And Helen, you talked about profit warnings from your members. Josh talked about a lot of people feeling vulnerable. Craig, you actually gave us some figures. I think you said 500,000 had exited over the last couple of years. And so I'm going to address the question first to you, Craig, and then move on to Josh and Helen. But we'd been wondering, within your sectors, do you maintain reliable figures on current closure rates, and are those likely, to the extent to which you feel able to look forward over whatever period you do look forward, are they likely to get better or worse? So Craig, to you first.
Great question. Yeah, we have contracted quite remarkably, but that would have been much worse without the huge COVID support. That's good, so that kept 90% of our community going, and is really, really important. I think we've got a couple of other sources that might be useful. One is we asked a question in our survey data about, are you planning to close your business, to sell it, or to shrink it? And that remains quite high. It's about 14%. The run rate for that normally, because you always have churn in the economy, is closer to 10%. So that increase is going up. That's why the increase has gone up. And actually, the smaller the business, the higher it is. So if you're looking at self-employed sole traders, who are at the smallest end, that rate of closure rises up to 16%. So that's really quite high. ONS do some good stuff about cash reserves, which is useful here as well. 42% of businesses, micro businesses, so that's 0 to 9 employees, have less than 3 months cash reserves. 13% have no reserves whatsoever. And this puts them in an incredibly fragile position, and that will then tip over into those closures. The final kind of source is corporate insolvencies as well. We're looking at those figures, and they are relatively high, about 1,800 a month, when the run rate is normally about 1,200 historically. So that's running at a very, very high rate as well. I think throughout all these measures, the smaller the business, the higher the closure rate, which of course makes us arguably the most, I'd say, the most nervous on what will happen next.
Thank you. Obviously, a lot of figures there for us to take a look at as well. Josh?
Yeah, thanks. I'm sure many of you are sadly aware that the number of pubs in the UK has been declining for a long, long time. And it can be a bit of a challenge to divine the closure rate for pubs, because it's not uncommon for pub businesses to undergo temporary closures. But we work closely with a consultancy called Altus, who measure pub closures in England and Wales, and that's based on VOA data. So it should measure net permanent closures, and their numbers in the last few months are coming out at something around 10 to 12 pubs a week which are closing, which is, to put it mildly, is bad, but not entirely surprising, since our members, we survey our members regularly, and that indicates to us that only a third of them are able to turn a profit at the moment, and that's a figure that's declining. And if you think about each of those pubs as an individual small business, an individual community hub, actually, if you just think about those as your local pub, if there is a local pub that you go to, then you begin to realise the cost that entails to communities all over the country. And if trading conditions carry on as they are, that like I said, that is a trend that's likely to accelerate. as I said in the answer to the previous question, October and November tend to be very challenging for pubs, and arguably January and February are even more so. We've got things like Dry January, which hit pubs really, really hard at an already difficult time. So the picture's not a pretty one. And if we look at, in the kind of short to medium term, interventions like a cut in VAT for hospitality, and as Helen and Craig have both mentioned, business rates, something, some kind of action on business rates reliefs for pubs specifically from my perspective, obviously. But those kind of interventions would be absolutely vital to kind of stem some of those losses and stem the closure rate.
Yeah, well, I was actually in my local pub watching the football last night, and it was student night, and I did really wonder how the students managed still to find the money to turn out to the pubs, and what the impact frankly, on students and others, the knock-on effect that will have on your trade as well. And Helen, anything positive that you can find for us?
I'll have a little bit of a go. We don't track number of retail businesses and failure rates. There is some market data I can see if I can come back to you on where it comes from. What we do track is vacancies, so stores. And what you can see from this is that there are still around the country, around 14% of our retail space in different communities is empty. That obviously varies hugely depending on locations. Some locations, particularly in the northeast and the northwest, are much higher than 14% and more likely to be closer to 25. That is a worse vacancy rate than pre-COVID, but it actually seems to have shallowed off. So there was a big drop off during COVID where there were lots of closures. I think many of those will feature in the numbers that Craig has given you in terms of his 500,000 businesses that have closed, because some of those will definitely be retail businesses. What we haven't seen is any sort of major multi-site or large retail business failure since the days of House of Fraser and Arcadia. So we did see some big businesses come out of the market during COVID and just before. So what happens with that vacancy rate is a big sort of economic question, because if that can be reduced and the cost of operating, which comes back to particularly to business rates and energy support, then that's local jobs in local communities, economic vibrancy, and it's particularly in those areas of the country that are most deprived. So the good news is, if there is a piece of good news in there, is that at least it seems to have stopped getting any worse. And I think if we can bring that certainty as we look forward, then hopefully it can start getting better.
Well, I think we would like to follow up with you on the source of those figures, Helen. So that'd be very helpful. Hilary, conscious that we're chasing the clock, I'll pass it back to you.
Stephen, thank you very much indeed. Jeff Mackey.
Thanks very much, Hilary. We've had a number of conversations this morning about price rises, and I wanted just to take a view of that and also to try and produce a slightly wider benchmark briefly. How is your industry feeling the effect of the price rises, and could you give us some idea how these compare to price rises elsewhere in various parts of Europe, please, where you can? Helen, could we start with you in retail, please?
We're all seeing it in our daily and shopping. I'm sure the consumer price index is there for us all to see. If we narrow down within what sits in there to sort of shop prices, so the prices of goods, whether they're online or not, then food inflation in shop prices is running at about 10 to 14%, depending on which data source you use. And in non-food, it's somewhere between 4 and 6. So as I can't remember if it was Josh or Craig mentioned earlier, that is a function of input costs into businesses, inflation, and some of that being passed on to consumers. So there is a there is only one way to go, either reduce profits or increase prices is the sort of response to increases in businesses' own costs. And we are seeing that flow through, and everybody I am talking to is not necessarily seeing that alleviate, if there is such a word, over the near future. So I am a little bit more pessimistic than Mr. Bailey at the Bank of England that inflation is here to stay for longer than he might anticipate, because of the input cost inflation that businesses are continuing to see.
Thank you very much, Helen. The value chain continues to add challenges. Josh?
Yeah, thanks. Well, Helen's covered the increases on food there, which is broadly similar to what we're seeing. So I'll focus on beer. Unfortunately, we don't collect data on beer prices across Europe, but I am going to Seville next week, so I'll report back on the situation in Spain, if you like. But in terms of prices in the UK, our data suggests that the price of lager has gone up by 6% in the year from September to September, and the same number for bitter is 9%, and across the board more lager is sold. So the data that we have suggests the weighted average is something like 7%, and that's so far. I would just caveat that with there is a bit of a lag in those, because our members, the publicans, do try and hold back price rises as long as they possibly can, with footfall already dropping off, to try and sort of stem some of that. And from speaking to a lot of our brewing members, there was a reluctance to pass on too big or too many price rises for fear of spooking the customers at the worst possible moment. And that applies to publicans as well. The last thing they want to be doing is putting more pressure on people to give up those occasional luxuries. And much of the last 8 to 10 months, I suppose, has been, we've just been seeing profit margins already very, very thin in our sector, profit margins being completely eroded, which is why the situation is that I've outlined in previous questions is quite so precarious. And again, that speaks to that argument for easing some of those pressures on those margins, for example, by putting VAT for hospitality back to that 12.5% that we saw, or less than that. We'll take less than 12.5%, but putting it back to the sort of emergency temporary rate that we saw during and just after COVID.
Thanks, Josh. Craig, particularly with your members, comments across Europe, some comparisons?
I'll do you in a second, that's okay. We don't have price comparisons, we have other comparisons. But for the UK, I did give you the figure of 89% say their costs are up. And I think we are seeing that influence on the prices that they then charge. So they have passed on some of that charge. It's the last but one thing a small business owner will do is to pass on the cost to consumers. We ask people, how will you afford the energy increase that you are now facing? And of those, 45%, the top answer was to raise prices. Then the next one was to reduce energy consumption, which of course we need to get that high. I don't think that's quite important in public policy. How do you do that? And then others were cut back investment, about 24%. And also in really bad news, cut back on green investments. So they were thinking about greening their business and put that on hold while they work out how to cope with these increased costs. So I think the impact of the cost that they're facing and the prices they pay is that investment is down, recruitment's down, export is down, everything is falling. There are red lights all across the dashboard. So, anecdotally, a restaurant cannot suddenly start charging £25 or £30 for a pizza. A laundrette can't increase its prices by 150% because hard-hit consumers can't afford it. So I think we're probably reaching the edge of acceptability on price. And what we're now seeing, and I've got lots of reports of this, is small business owners not paying themselves at all. So they don't take any money out of their business. They don't look after themselves. The last thing they do. And then if price is last but one thing they do, if not paying themselves is the last thing, then you're left with, how do I downsize my business, which is what you asked for before. I think across Europe, what we've looked at rather than prices, I'm afraid, is about the different packages offered by government. And I would say, in terms of to help with the price crisis, particularly on energy, and I would say Britain is, or the UK is probably in the middle of the road, being quite generous with the energy package in particular. Without that, we would be at the bottom. But what's interesting is that every country's done it differently. In Austria, they've done backdated energy costs help for about 30%. In France, there's an energy price cap in the consumer market and the business. In Germany, it's a discounted basic allowance along with reducing heating and lighting and its public buildings. And in Italy, a VAT fuel cut. So I think everyone's choosing different mechanisms. There's no single approach. And that probably reflects how difficult it is to have a single market that has exactly the same pressure because it's structured differently in each nation. So it doesn't quite answer your question, I know, but it's basically the best that we could get.
Thank you. Back to you with a rather large thudding noise, Chair.
Thank you very much indeed, Jeff. Now we're returning to Stephen Kinsella. Stephen.
Thank you. Now, we've touched on some of these issues already, but obviously most of your members are very much consumer-facing businesses, and you've talked about consumers. Helen, you mentioned consumer confidence and the importance of that. So we wanted briefly to look at the impacts that you've seen on your industry through changes in consumer behaviour. And also if you can call out what types of change we're talking about. For instance, are they switching or are they actually exiting? Are they just no longer showing up at all? And to the extent you can comment on this, what are the future? Are there further consumer behavior changes that you foresee that you're fearing? And maybe to start, in this case, take Josh first, then Helen, and then Craig.
Yeah, sure. Thank you. So just to address one of the specific points in your question there, anecdotally, we have seen some evidence post-pandemic of consumers moving their spending to more premium products, so switching from what we term as a standard lager to a premium lager. But that isn't, there's not much solace to be found in that when the absolute level of footfall is at the same time decreasing quite substantially. I think it was Helen earlier who referenced that although you might see revenues holding up, profitability is still down significantly because of all the issues that we've already touched upon. And we know there's a survey recently that suggested 36% of UK consumers are going out less frequently than they typically do or that they used to do. And that in itself was a 3-point decline on the previous month. So it suggests that is a downward trend as households become more exposed, if you like, perhaps to the cost of energy in colder months. And again, maybe it's to do with anticipating mortgage prices and holiday price increases and things like that. In terms of what we expect in the future, again, it's hard to predict what Christmas is going to look like uniquely this year because of the World Cup. And we're hopeful beyond hope that trade holds up over the Christmas period, and that allows some of those profits to be banked that will kind of enable us to make it through the early months of 2023. We do know we're already seeing actually an increasing trend for pubs to be closed 1 or 2 days a week. And that is a combination of factors from staffing costs, energy bills, and so on and so on. And I would expect that trend to accelerate in the early months of 2023. I would hope, and certainly our members are hopeful, that will remain just part week closures, because that in itself will feed into consumer behaviours. And we've already seen actually in off the back of the pandemic, that kind of late night trade has all but disappeared. There has been it looks like a permanent shift in behaviours. Pubs are closing earlier because that trade just doesn't exist beyond 10 o'clock at night anymore. And that's partly because people just got into a groove, I think. And what we don't want to see is people get into another groove where you just don't go out for a pint or a meal in a pub on a Monday or a Tuesday, because for obvious reasons that just knocks a huge chunk off of our opportunity to get money, frankly. So we're hopeful that those will just remain kind of temporary changes, but we just have to wait and see on that front.
Yeah, I find that switch to premium quite interesting, though, as you said, if the overall volumes don't don't increase, then that doesn't help your members very much. I mean, Helen, maybe obviously your members will have their own observations. I wondered also in responding to the question whether you have a lot of access to surveys of consumers and the reasons that they're giving, to the extent you're able to ask them.
We do use Nielsen's data on consumer sort of sentiment and confidence about how they're feeling about the future. So I referenced some of that earlier, and it just interestingly, which sort of comes back to Jeff's point, I'm just looking at my notes now. It says that our consumer confidence levels in the UK are lower than the OECD average. So that's an interesting one to note, that the sort of consequences of the environment in which the UK seems to sit seems to be impacting the general public in a more negative way than it is in other countries. Just picking up, I sort of connected to that, some more data, actually not from Nielsen's this time, but links to Josh's point. Some Google data was highlighting that pre the sort of last sort of 6 months or so, there was less searching for the word cheap and more searching for the word best. But that has started to reverse over the last couple of months as people have been looking for cheap. So again, that I think plays into the impact or the consequence of the environment. Demand is shifting from lifestyle to much more functional expenditure. So, less sort of looking for holidays and more looking for sort of local nights out, which I guess might be good for Josh and his members. But also seeing a decline in big ticket items, whether that's big ticket furniture items or, house purchases, car purchases. That Google data is definitely, the search data is showing that. Maybe another little gem of a positive is more people are searching for pre-loved and refurbished as opposed to new. So that is a trend that we are seeing more of in investment in things that have been used before, secondhand, pre-loved, whatever we'd like to call it. And what we can certainly see, the supermarkets talk about it a lot, is in people's food baskets. People are trying to buy inflation out of their basket by shifting to more value ranges, changing the nature of what it is that they're putting in their basket so that their own personal inflation is not as high as the sort of headline number that gets quoted. They'll do that by shopping around, by changing the ranges of which they buy, or changing the products that they're buying. And there is definitely a trend towards that. And at a more macro level, from a retail perspective, we are still in the midst of this transformation from a much more sort of connected digital and physical type of retailing. So in 2021, 25% of our purchases of goods were made online. So that is £1 in 4 was spent online versus in a shop. And I think the interesting thing for every retail business, whether it's a small one or a gigantic one, is that they're all trying to think about how they integrate those two things and how they connect them much better, which does require investment and people within their business to be able to do that. And that, again, that sort of plays into, are they able to make that investment when they are worrying about whether or not they've got enough staff for the next 3 weeks, because that in the moment issue is overriding the more sort of significant and strategic one.
Yeah, no, absolutely. I'm relieved we don't need to change best for Britain to cheap for Britain yet, based on your feedback. But I think something we'd want to come back to, we're intrigued as to why we would be lower than the OECD average on consumer confidence. But that's one of the main themes we are looking at the moment. But Craig, I guess with your members, of course, it's true for all of you, but yours in particularly, your members are also consumers. So you're probably getting hit from both angles on this.
Yes, that's actually a good tack. So in our stats, we show that 32% of members say, in the same survey, 32% say that consumer demand is the main barrier to growth that they face. So that is a big deal, and that is going up. So I guess my concern would be that most of the worst things to affect consumer demand haven't actually happened yet. They haven't really hit in full. Energy bills have not risen by as much as they're going to. Mortgage rates are not up as high as they're going to go. So actually the prospect coming forward is actually very worrying as consumers worry more about these two things. So at the moment, they're withdrawing a bit of spend because maybe they've been hit to some degree, or they're mostly worried about what they're about to be hit with. So its prospective start to shrink of demand. Very worrying as everyone tightens their belts and battens down the hatches, to mix my metaphors really terribly. I think small businesses are reacting to this by moving into a bit of a survival phase. And that is a problem, is it means, as per Helen's point about investment, we're ignoring kind of prosperity and growth medium term. So that autumn statement, I think, in that context, suddenly becomes crucial. It can't just be on the 17th, sorry, is it 17th November? In November. It can't just be about tax increases and spend cuts. They've got to look at some of that supply side stuff. Broadband, that 5 billion that was promised by Boris Johnson 3 prime ministers ago, only 1 billion was ever allocated. Business rates, you've got, if there is, at the moment there's a revaluation coming for April, which generally sees bills rise. If that revalue is cancelled, you get a 10.1% increase in inflationary increase in those bills. So we can't just let it pootle on and hope it gets all right. And I think the final point I'd say about consumers is, in all this mess, consumers have real power. And I think the choices they make matter. So one thing we are developing is asking consumers, consider where you shop, consider where you drink, consider where you spend your cash. Yes, there is a cost of living crisis, but also think about the money that you do spend and what it then leads to, where you do your Christmas shopping. Maybe you don't all do it all from the biggest firm, but also think about your local shop, your local retailer, your local pub too. If you go to a mega store, some portion of your money will stay locally, but most does not. While in the small business, the money stays in the local economy. So we're saying it still matters where you spend your cash, even though the cash may be a bit less.
Yeah, and I'm struck by Josh's point that a lot of these changes in behaviour may be longer lasting. But Hilary, I think we need to come back to you now.
Stephen, thank you very much indeed. Next, it's Deborah Annett. Deborah.
Good morning, everybody. I know I'm speaking to you from the perspective of the music sector, which is really struggling at the moment with things like energy costs, etc., and discretionary spending. How do you get people to actually come to a show or a concert or a gig or whatever? So I absolutely understand it's really, really tight out there at the moment. So my question is around, how does the uncertainty over energy prices after April 2023 affect your sector? What sort of support and guarantees does your sector need? And that may also be fiscal intervention, so things like VAT, business rates, etc. So think quite broadly in your answer if possible. So if I could come to Josh first, that would be fantastic.
Yeah, thank you. It's very difficult to think about this in there's not really one single thing that we would say overrides everything else in terms of what we can get in terms of support. So I think I'm going to kind of circumvent that by saying the most important thing, and all of us have touched on this already, is we just need to alleviate some of that tax burden on pubs, particularly. Already £1 in £3 spent in the pub, and by the way, the pub, hospitality sector and music are very, very closely intertwined, so it's no surprise that you see some of these, there's a lot of harmony in the issues that you see. £1 in £3 spent in the pub is spent, it goes straight into government coffers, and I would just pivot back to those things I mentioned earlier. In fact, they are the core asks of our Long Live the Local campaign, which I should have already mentioned, but we recently passed 150,000 supporters. But the kind of key asks that are contained within that, so cutting beer duty, cutting VAT on hospitality, and fixing the business rates system, those are the kind of 3 key issues for us. And the pressure on pubs and brewers built up over the last 3 years are becoming unbearable. And if the government is serious about stopping business failure in the short term, never mind growth, then it needs to consider some of those targeted measures on vulnerable sectors. And I would also, all of us have already talked about this, but I would come back to the need for certainty on a package of energy support beyond March 23. If our members, brewing and pub members, are going to look at 2023 with anything other than abject terror, then I would hope that the government will look at these kind of short-term interventions that will directly support what is the backbone of so many communities. So I would urge that in the strongest terms to use that 17th of November as an opportunity to kind of alleviate some of that taxation burden.
So really, I'm again just kind of thinking about the duality here. Definitely in music, we're tremendously worried about how do we keep venues functioning? And that is very similar to pubs, isn't it? How do you actually keep your plant running, your energy costs manageable? And VAT is a constant worry.
Yeah, absolutely. And I think it's just on energy specifically, I think it's underestimated the extent to which pubs are users of energy, because you've got to heat the main part of the pub for your customers, and you've got to keep the cellars cool to keep your product alive, you know. So this is a product with a relatively short shelf life. So you're effectively, you know, you're getting hit from both sides on this front, and it is absolutely existential. You know, how do you keep the business going? And I think, you know, sadly, I think that does mean that there's less ability for publicans to focus on things like how do we kind of promote ourselves as an individual business, because they're just concentrating at the moment on keeping their heads above water. And the last thing they need come April 2023 is a massive increase in their business rates bill, for example. And indeed, it would be much preferable if we could be talking about at least a freeze in beer duty and a lower rate of VAT.
Absolutely. Can I come to you, Craig?
Yes, I think the business energy package really has to work. So it hasn't started yet. People haven't got their bills yet. We're a little bit worried that this is actually, there's an uncertainty now, not just in April 23. So I think it comes from the fact that it's a very difficult thing to regulate business energy contracts. Because it's not the same as consumers, where there's already a consumer cap to work off. So the government's already changed, for example, on a fixed rate contract, it's clear what will happen when the prices are confirmed in your contract. If you're on a variable contract, you get a discount, a maximum discount of help. And the government changed the rate that was actually going to be charged at for energy, for both electricity and gas. So we want to see how that really works. They have listened on one thing, which was they had a cut-off, which was all the way back to April. The help is from October to April to come, but they had a pre-cut-off at April, which meant for those businesses who signed up in February and March with increased costs, they were not allowed to get help from this October to April, which was a bit dim. We don't think that was any help whatsoever. It was just to protect the public purse from a risk that wasn't there. So we managed to change that. So hopefully the government will adapt. The 6 month is a problem. I think it's probably the bigger a business you are, the bigger a problem actually it is randomly, because the small business, when the smaller you are, you work on a 3 month planning horizon often. So I think we need assurance at that 3 month point, that January, February point, when the Bayes review that would lead to whatever happens on the 6 month cliff edge has now been moved into a Treasury review, and you've moved that business kind of review alongside a consumer review. So they've changed the apparatus, and we need to get a feel for what they're going to do. We are concerned they might do vulnerability kind of based on sector. Sector-based public policy interventions tend not to work very well because you have people, suppliers to that sector who aren't there. And I think on energy, I fail to see a sector that isn't affected by this energy crisis. So we would like it to be looking at, you know, how much a bill has risen, perhaps as a potential, maybe linking across to turnover or size of business, where you just look at those, because we are worried that the most fragile ones are lower down. I think in terms of measures, I would go down the same route as my fellow panelists. So I think you've got to consider, as well as cost of living crisis, cost of doing business crisis, we should be looking at the cost of doing government in this, because the tax burden is so high and VAT and business rates keep on being raised as they are very high and very difficult to operate. And if you're going to do one other thing, can I cheekily add in our idea for a help to green scheme? So if you're trying to reduce energy use, then this would be a way of having a voucher you could use to invest and reduce your net zero impact, but also your energy use. And suddenly you're helping everyone at the same time.
Thank you very much, Craig. And lastly, Helen.
Yeah, I mean, my no surprise themes are very similar to what's already been mentioned. So two headlines: rates and energy. On energy, I think Craig is right. We need to. So it's the conversation often is all about sort of support. So I think the energy market, the whole sort of way that every other energy cost, whether it's electricity or is all, whether green energy, is all linked to the gas price. There was in the Truss package, I think, a beginnings of a window of a focus on looking at how you decouple the other aspects of people's energy bills from being tied into the global gas market. So I think the energy bit needs to think about the market itself as well as support and about usage, because I think we absolutely need to be, and certainly lots of my members are telling me that if you really focus on usage, and I appreciate in a pub it's much more difficult, but because you've got to keep the people who are in the pub warm, but what do you do at night? How do you, how well maintained is all your equipment? I mean, all of these things sound really simple, but actually I think there is a big 10 to 15 to 20% opportunity in terms of usage gain to be got if everybody really understood better what it is that affect their own energy bills. So I think the energy perspective needs to be much wider than just about support, but obviously from an industry point of view, what happens in after March is the most important thing, I think, from now, certainly for us, because most of my members are bigger than Craig's, and so aren't really going to see the benefit today because they've already hedged most of that outlook right now. So it's much more about what happens next year as opposed to what's happened today. And on business rates, I would say recognizing that everything everybody said at the moment is going to cost X billion pounds for whichever chancellor it is that is having to look at it. I would say the one quick, easier win is to look at the transitional relief system. And I'm sure there's no business rates experts on here that want to spend the next half an hour talking about business rates, but this is a very strange system that basically stops people who should be seeing a reduction in their business rates bill because of the valuation when it kicks in, will be held back from receiving that reduction because of a sort of smoothing of the implementation of it over a period of years. So if they could look at that, that would actually mean that people could pay, even with the anomalies of the system that we have, at least pay what technically they should owe rather than some inflated number, and that would have a benefit for many businesses in places that have seen rents fall in their local areas. So business rates and energy with a sort of broader perspective than sort of looking at it from a core support point of view, as much as I'd love lots of support.
Thanks very much, Helen. Back to you, Chair.
Deborah, thank you very much indeed. Now, Stephen had the last question, which was just to steal your thunder, what were your main recommendations to the UK government? I think we've covered a fair amount of that in the answers we've just had to Deborah's question. But Stephen, is there anything else you'd like to ask on that front?
I think you're actually right. I mean, it's traditional, isn't it, at the end of question time to have a very short and simple question, which clearly this is. I mean, I suppose it would just be the very quick answer, something that would even go on a poster. If this government now is listening a bit more than the previous ones were, what would be the single pithy thing that you would want to ask for? And maybe go Josh, Helen, and then Craig.
That's hard. I think if we just take the energy package as read for the time being, as Craig mentioned earlier, the single biggest bill that our members see is business rates. And if we were to look at, like I said, if we were to project forward 6 months, and there's enormous business rate bills hitting doormats in that time period, just on the back of that January-February time, it's just going to be a disaster. So I think that I would, if there was one thing, if I absolutely had to focus on one thing, I think some sort of relief on business rates would be the most significant.
Was I next, Stephen? Sorry, shall I go? Yeah. Yeah, just building on that, abolish downward transitional relief on business rates.
Thank you. Craig.
Lovely going, Lars. I met the Chancellor on Tuesday, so actually I've got an easy answer, which is after immediately implementing energy and NICs, the question is, where are the growth and prosperity measures? And in that, business rates, late payments, regulation, broadband and immigration. So how's that for a pithy but rather large response?
That's excellent. Thanks very much. And thanks for giving us some extra time as well. Chair, back to you.
Stephen, thank you very much. Look, on behalf of the commissioners, can I thank you, Helen, Josh and Craig for another really interesting and valuable session. And we are so grateful to you for giving up your time and offering your experience and expertise, because as we've learned from just listening to you this morning, this is a really tough time for all of the people that you represent. And the more those who are making policy decisions can hear and hopefully understand the pleas for assistance you're making, hopefully the better the outlook will be. Thank you very much for joining us today. And with that, I will bring this evidence session of the UK Trade and Business Commission to a close. Have a great day. Thanks. Bye.
Thank you. Thanks. Bye.
Thank you for the opportunity. Thanks.